we bought this deal, and where it goes to show, like, you can be unhappy with certain things despite how good a deal does. We're going to be in year 10 of the broker's pro forma projection in year 1. So you might say, Michael, why are you not happy with it? Well, because when I looked at the market as a whole, and this was the first time we did out of state, I do think we overpaid by probably about 10%. So not a big deal. And again, we'll get there on the income basis, but on the comp basis, there's no comps that are going to make it pencil the way we want it.
Yeah, but is it multifamily?
Yeah, 48 unit, yeah.
Yeah, man. I mean, the appraiser will 99 times out of 100 go to the income approach, so.
Yeah, and we'll be there, and we'll be fine. And that's where, again, it goes the runway. But I was more mad at, like, the lessons. We always try to take, okay, what do we like that we did? What can we do better? And on that one, I think we could have beat that. I think we could have squeezed probably another $10K off a door from the guy.
Well, sounds like you're already crushing.
I appreciate that.
Yeah, so, Michael, interest rates are basically little more than double what they were 2 years ago. Burring properties is dead, right?
Fuck out of here. Who said that?
That was my leading question for you.
Interest rates are dead for people who shouldn't have been buying real estate to begin with.
I love it. I like that.
Show me your intentions, and I'll show you your outcomes. And we've talked about this a little bit, Collin. If you're getting paid primarily just on fees, and you're building your business where you have to transact, you're in trouble. And you're going to be in trouble because you went into it and your intention wasn't all the benefits of real estate. Your intention was to make money transactional, right?
Right.
Well, I don't know. Maybe it'll hurt some people's feelings. I don't really care, whatever. All you had to do was look at it and say, we're at historically low averages. How do we stress test this deal? What's going to protect our capital stack? What's our timeline on return of capital? And that's really it. It's really fundamentals. And multifamily is still such a great asset class, but you overpay because you're being propped up by cheap debt. You weren't buying a deal. You were buying a discounted banknote against inflation.
Right.
We buy deals that we know we force value just like you guys. We buy true value add deals. That's kind of the fundamentals. So, yeah, I mean, the Burr method, I guess. I've heard that before. I just think people are lazy. That's what I think.
I would actually say that we're in a better position now because there's a much lower chance that rates continue to climb. And when rates go lower, if you bought something today and rates go lower, it just naturally appreciates. Now, I don't want to say that as a guarantee by any means, but when you're buying stuff at 3%, it's hard to go any lower than that on the rates. So, I mean, but look, you bought stuff, right? Obviously, you bought stuff when you were getting 3 or 4%. And when that stuff comes ballooned or restructures itself in 2 or 3 or 4 years, it will change the value of the assets. How have you kind of prepared for that?
Well, it starts at the end in mind. So when we buy a deal, we're long-term holders to get infinite returns. The way we've always internally underwritten, going back to when we first started, because we got burnt by a bank when we first started, is we look at the dirt and the deltas. We look at what we're buying. We look at what's going to take to execute the business plan. And then we stress test that up to whatever rate we can support. And we have to be at a 1.4 DSCR. So as you know, most lenders are 1.2, 1.25. So if we don't hit that 1.4, we either need to renegotiate the price, look at the business plan, or walk away from the deal. So the way we hedge is, we have, say, one of the buildings we're doing now, we have 12 to 18 months to stabilize it. Okay, well, if we're buying it with a rate at, say, 7, and we stress test all the way up to an 8.5, 8 3/4 to still get our cash out refi, that's how much meat's on the bone, right, for what we're buying. That's how you protect. And if it goes down, great. But if it doesn't, we're anticipating, them going up a whole basis point and a half. It can happen. We just went through it. But let's also not lose the context of how we arrived there. Those were historically low rates that ripped. And once they got back in line with the average, you see how things have kind of leveled out with a more normal curve. Normal curves go both ways, guys.
Yeah.
And, in my opinion, and I love you guys' input, they still haven't fixed the baseline fundamental of the supply issue. Right? So right now, no one's building. So what happens 26, 27, 28? What do you guys think in your markets? Where do you think rents are going?
Up. They're going up.
So if you can hold right now and you can make it work, how do you think things are going to look 24 to 48 months?
We have a property manager we trust. We do most of our stuff in-house, but we have a few third parties we trust, and they do a lot of Class A stuff and a lot of Class B, but they're really good at Class A. And I just had a meeting with him last week, and he was saying, look, in the city he's in, we've completely shut down on building permits. Like, it was extremely saturated in this market. And it's filled all the way down to Class C, to be honest, because we're in that market as well. So Class A can't get what they thought they could. So now they're charging Class B rates. Now Class B rates are charging Class C rates. But he said 2 years from now, this is Zomer.
Yeah.
2 years from now, he's like, there's nothing being built. So the rent can only go up. And he's not the first person I said that, but it's great to hear, we're all drinking the same Kool-Aid, us three. Like, it's good to hear people from other perspective as far as the property management or whomever. So that's really exciting for us.
Yeah, but don't you also think that it's where we invest as well? I mean, our rents, we have rents on the rent roll that are maybe $695 that were at one point $450. Go anywhere else in the country and find a rent that's $695 and not be able to increase that rent to $750 at a renewal. I mean, so we still have all this room there. People's wages have gone up throughout the country. There's obviously inflation all over the place. So the fact that rents have always been historically low or just relatively low in the Midwest still gives us that runway to still increase rents on these properties, regardless of the situation of supply and demand. Obviously, that will affect, there was a ton of building, but to your point, with there being no building now and also being in the Midwest, I feel, we do have additional layers of insulation.
Can I expand on that point, though?
Yeah.
Because I think everyone misses the most important point of the Midwest and the built-in advantage. And it's one of the reasons we've gone out there now. Wage growth lags ahead of rent growth, right? So, like, we're investing in Cleveland right now, and everyone goes, well, why Cleveland? Why Cleveland? Well, again, I'm not that smart. I'm not a Cavs fan. But the reason we're going to Cleveland is we can pick up something in these markets for $40 a door, put in $5 to $10K a door, and the rents are going from $600 to $969. So I'm getting an infinite return on an asset in a market where there's no supply coming. Now, I don't lie to myself, right? This is not an appreciation market, but once I get an infinite return, and this goes back to the start of the call with Chris, we were talking about that. What are you investing for? I'm investing for velocity of money, cash flow, tax benefits, principal pay down, all the benefits. So I want to go in markets that reward me solving those inefficiencies. It's just like you guys. So when you buy it at a discount, you get to ride that wave up. And then even if it's just natural 3% from that point forward, your total return, right, is infinite.
It's awesome. And I've had this conversation with so many people about it. I had a conversation with CFP recently, and he didn't like that we were using the term infinite returns. Well, mainly because CFPs can't use language like that. But people look past the fact that it's sincerely infinite once you get all your cash back. And then his response was, can you say that about the stock market? Like, if you put 100,000 into the stock market and then it increases up to 200,000, which, by the way, is going to take 8 or 10 years. And if you cashed out 1,000, are you calling that infinite returns? And I'd say kind of, but when you cash out that 1,000, you're having to pay gains, which we're not having to when you refi. And you don't have someone paying down the equity, and you don't have any write-offs. So, like, it's not even a comparison. And I'm just glad to hear you say infinite returns, because I like when that's.
It's not, again, and that guy, I don't know who this guy is. Maybe he's smarter than I have no idea. But again, what I go back to is, let's talk about what is money, what is wealth, what is currency real quick. When you buy a stock, and this is the example I give everybody, right? Take the safest company, take Coca-Cola, okay? What do you actually own? You own the paper that's a note due on a share of a company that's so far removed from the actual product they make. If you wake up to the CEO said something stupid overnight, you're somehow 10, 20, 30% poor, and all you did was go to bed. We are buying what's real wealth. We're buying bricks, sticks, copper, dirt, things that actually have intrinsic value that hedge against inflation.
Yeah.
Right?
Yep.
And I think people don't understand what money actually is. And if they had a basic understanding on that level, they would start to understand that real estate, and more importantly, you said something, again, that hopefully all your listeners listen to over and over, the velocity of money. people always say it all the time. And I just think they don't understand, in my opinion. Oh, I sell. I sell. Why? Short-term gain, to say you got the bag, to brag for the great. I have no fucking idea. I don't know. When you take a cash out refi, it is tax-free money, right?
Yep.
I get to look at the biggest expense. I'll ask you both. What do you think the biggest expense of your lifetime is?
Taxes.
The government.
Yeah.
And no one understands it. I ask that question all the time. When you factor in paying taxes versus not paying taxes, and then you compound that return, real estate smashes the stock market every single time.
It's not even close. Not even close.
I mean, typically most of the businesses and lots of things in America and most countries are set up from like an economic standpoint to have individuals work to pay taxes to fund the government. I mean, that's how it functions. You know, I really like what you were saying there about the velocity of money. And we just had a conversation on this last podcast, and, you know, talking about the fear of debt, because just back to your point, people not understanding currency, money, et cetera, and being fearful of debt. When I think the light bulb moment for me was realizing it's basically an arbitrage on banks' money to an asset, and you're getting the delta in between. So it's an actual vehicle for you to make money off of the arbitrage. And every time somebody hears debt, I mean, this is very basic for us, but, you know, good debt, bad debt, car, bad debt. You know, you can say it whichever way you want, but that's not good debt. You know, you put it on a building, you're paying 7%, but your return's 10%. You're arbitraging to 3%. That's just an incredibly simplistic way to look at it, not including the value add, the tax benefits, and all those other items. But yeah, just some of those basic items, and especially now the past 4 years of how much inflation there's been and how much the economy's changed and wages have not kept up. If you did not own assets, it's not too late, but it's really difficult to keep up with how much everything has gone up in price.
Michael, where are you at? Where do you usually invest? We haven't gotten into that.
Yeah, let's do that.
So I bounce around between New Hampshire and Montana and Arizona. And we invest kind of all over the country as well. We invest in New Hampshire. And then we Maine, Montana, Missouri, and Ohio.
Good for you.
Primary markets. Yeah.
Why do you like those markets?
Honestly, that's one thing that personally, and I don't know if you guys agree with this or not, I think real estate is changing in a way that I think what we're doing now is seen as odd, where I think the next 10 years is very commonplace. Real estate investing in a lot of ways is finding an inefficiency, solving that problem, and taking, advantage of the inefficiency to make it efficient, right? We just go with technology where more markets find inefficiencies. Like I started to say earlier about Cleveland. I don't really care about Cleveland, but we saw a big gap. Missouri. How did we end up in St. Joseph's, Missouri? Well, we saw a 2006 vintage building that we thought we could get $1,300 a month for the units for, and the broker thought the market rent was $900. Right? So you see these inefficiencies, that's where we go to. So like right now, I'll tell you a market we're starting to look at is the Vegas market, right? Why are we going there? Well, huge population growth, taxes, business friendly. We think we can get in there and take our model, because one thing that we do that's a little unique, I guess, is we manage remotely. So even though we in-house manage, we actually manage remotely from New Hampshire. So, that goes back to, like, if you guys even look at a portfolio your size, and I'd love to get your opinion on this, Collin, this one thing we talked about, we met at the 50. In a portfolio your size, your best leasing agents to your worst leasing agents, right? Technology is allowing you now to leverage your best people on more of your portfolio if you allow it to. And in a business like ours, it's so driven by NOI, we're just trying to create more leverage to spin that flywheel faster in more markets. I know that's kind of a long-winded.
No, that makes sense. Do you separate? Okay, so one, I forget. Are you syndicating or joint venture or what's?
No. So the way we've got up to this point, we do some syndication now, but even that we do a little unconventional. So we've always done creative finance. It was funny. I was at a conference and a guy was talking about buy real estate with no money, $0. I was like, this guy's a fucking scam. And then it hit me, oh my God, I'm that guy because I've bought my entire portfolio. So we do a lot of creative finance with debt. Now we've started to syndicate. But the reason I give that disclaimer is we want to get our friends and family in some of these deals because of the way they pay. So like our structure is we have a 7% preferred rate of return. Everything above that is 50-50. We do a cash out refi. We return the capital. The 7% pref goes away and it stays 50-50.
Yeah, we're pretty similar.
And we manage. Say it again.
Sorry, man. We're pretty similar.
Okay, cool. Yeah, like we don't pass through any cost on property management. We don't mark it up, I should say. So we do take an asset management fee, but that's more just for overhead. And we want to get people in to hold, right? Like I got my mother in these deals. I've got best friends. And what I started to look at is where we were going to it earlier, like how do we hedge against inflation, right? I was sitting on one of my Airbnbs in South Carolina and I was like, this is great. This is awesome. But it'd be better if my best friends were here. It'd be better if my family was here. How do we do this? And that has kind of been different to step into that space. There's some things I don't like about syndication. We don't even get pressured by investors. I just get more annoyed at the fact that I'm very hard on myself and I don't like having to put out like an update, right?
Yeah.
I just like it better when it's debt, right? I just write you a check and you're out of it and I don't have to worry about keeping you happy anymore. So that's a little different, but.
That's completely understood. I left the attorney game being a divorce attorney, and I thought it was the worst thing in the world, which, by the way, I'm glad I don't do it anymore. But I thought I was getting away from a little bit of stress, but then now becoming somebody who just invests other people's money, it's that they're pretty passionate about their money. So people have a lot of things to say. So obviously when you're syndicating stuff, you still have to deal with that stress.
Yeah. When you're taking somebody's money or utilizing their funds, I mean, I guess how I put it in my perspective, and I think, one of my first investors was my mom. It was after I made a buddy's mom, a $50,000 investment made her 170. And I was like, Mom, I think it's time you should put some money in. I think I can help you with this. But, I think about the dollars she gives me and the time that she spent working to get that. And that truly is the equation. If you are receiving somebody's dollars, that is a direct indirect correlation to the time that they have spent working and attaining those funds. So something that's incredibly important to, be the steward of, which, obviously puts on some pressure. I mean, it's good, but it's real. You have to be a good steward with their funds.
Dude, what you just said though, Collin, and that goes back to what you guys said earlier. Like we know some people that are having some hard times right now that I just can't believe. Maybe it's just my character. Collin, I know talking to you, like I don't know if they're just irresponsible. Like they took millions of dollars from people that are hard earned, and they bought things they should have never bought and made decisions they should have never made. And now you're looking every day on Twitter. There's just millions of investor equity being wiped out, and it's like it's so easy. It's like social media almost like numbs us to it. But that's people. Like people trusted you, right? The syndication starts from a standpoint of trust.
Absolutely.
And there was a lot of bad decision makers playing a different game. And when the tide goes out, we see who's been swimming naked. Yeah.
And I think one of the biggest things was, it was a big upswing. Real estate was really hot. And then what I saw a lot of was individuals that had connections to people that had money or, former sports players, et cetera, that wanted to get in the syndication game because they knew they could raise some capital. They saw the fees and they also saw that the previous 2 years were 25% year over year rent increases and put that into their pro forma. I mean, I saw that multiple times. I used to be a coach with a platform, and one of the students brought me something, and I think there was 5 to 7 points in fees, and the rents were more than double, and there was not one market comp, and they were 90% subscribed. And I was like, and I told my buddy he was going to, sign on the debt and everything and, help. He had some investors to help raise the remaining gap. And I told him, I was like, if this does work, it'll be great. But I think they're just, pulling on past data that's not indicative of future results. And and sure enough, that's exactly what happened. It was in Arizona as well. So I'm curious also, because we've talked about this, all these different markets, you're also doing Airbnbs as well, right?
Yep.
Okay. So how does that fit into the multifamily BRRRR model and why? What's the correlation there?
Well, one, it's just the first one we ever bought was an Airbnb, first deal we ever did. And two, it's the same thing. So as an investor, I focus on everything of like, okay, how do I get an asset that I don't pay for, right? Back to that inefficiency question. And short-term rentals are still a very inefficient market. There's a lot of headlines, a lot of fear mongering right now, which I find funny because it was the other way 12 months ago. but it's still a relatively untapped market, in my opinion. And it's a great way to diversify. There's a lot of unique benefits to it. And again, if you find a deal, so like every one of our Airbnbs has followed a similar model. And I like to short-term rentals because as a company, I fucking hate Airbnb. I can't wait 5 to 10 years when they're like basically out of the game, because they are going to get knocked off the pedestal because they can't just keep cannibalizing hosts who have the supply. But that's a separate conversation. But what we did was we said, okay, the first ones in Maine were in great locations, how we got started. Well, then we started looking at it and saying, okay, well, we want to own multi-million-dollar houses around the country where we travel, but how do we do it? Well, we found a very specific buy box where we found value add short-term rental deals, and they've all had a different element to them that we get to enjoy and cash flow and also vacation at ourselves. So now you've got a little different asset class. You've got the same kind of fundamentals, though, where you're solving an inefficiency for an asset that cash flows. So it's really not that different of a correlation. In fact, some of the technology and the systems from a short-term rental have helped in the multifamily, because we started asking questions like, well, if we can manage these remotely, why can't we manage a multifamily remotely? And then that leads to the same thing. Like, I was listening to a guy the other day on a podcast who I'm very intrigued by, because we built our portfolios pretty similar. He's much bigger than I am at this point. So I try to take stuff, but I like doing the ratio, right? So one of the metrics I ask everybody is like, what is your employee to door count, right? Like how many employees are you getting per door? Because that's the advantage of our model. That's what we try to leverage. So right now we're at 70 doors for every employee, right? And that goes back to NOI and all that other stuff. So that's the same thing in the STR space. It's what is my NOI? How am I performing? Where are my inefficiencies? And then how do I leverage those markets? That's kind of where I went with the Airbnbs.
Yeah. So something that's always that I've thought with. So I don't want to say failed. Didn't set up the right process with Airbnbs. Chose the wrong horse, right? Is that right? The wrong horse, probably wrong occasion, wrong timing. Didn't set it up.
You shouldn't have been the jockey.
I shouldn't have been the jockey. Well, I chose the wrong jockey. Maybe I was the horse being not led to water. And I couldn't find it fruitful, but I just turned it back to long-term rentals, which was the original business plan for these ones. If you come across, some legislation or anything, do you look at these projects as if they have to become long-term rentals or midterm rentals?
No, I hate that. I think that's stupid. People give advice on that I think it's terrible advice, and I'm going to tell you why. What we've banked our entire philosophy on with Airbnb is let's start again. All my opinion, people, please, comment, challenge, call me an idiot, whatever.
But if you don't believe you, then you're stupid.
Well, no, maybe, but no. The reason I said that though is if you bought it as an STR, use it as an STR and adjust it, right? So, for example, one of the big things that's out there, all these quote gurus that conveniently they don't post anymore because now they've been taken out because they were frauds. Avery Carl, but
name dropping.
Anyway,
we're name dropping.
They'll be whatever, but they'll go through it and they'll be like, oh, you can't lower your nights, you can't do this. They might do damage, and I have said it repeatedly. I go, wait, guys, this is commercial real estate investing. It is NOI driven. It is DSCR driven. No lender is going to say, you know what? We're going to give you more value. We're going to give you more cash out refund proceeds because you avoided all that cheap revenue from the damage that could have been done to your property. It's insane. It's insanity. So that's flaw number one. Number two, back to your rentals, Collin. We buy a very specific buy box. We will only have short-term rentals that are larger, meaning 4, 5, 6 bedrooms, because that's the advantage of a short-term rental. You have kids, you have a family. If you go on vacation and you get a hotel, it's not just a hotel. It's every meal, have an eat out. It's all the other costs.
It's 2 rooms.
When I buy a 1-bedroom or a 2-bedroom Airbnb, it's hard to compete with hotels. But when I start getting 4, 5, 6 bedrooms in a great location that's very unique, I have an advantage over a hotel all day. Like all my stuff, like one of my internal rules I use to underwrite, I will take 100% of the peak pricing for the hotel, and I will see what it looks like at 40 to 50% on my nightly rate per couple. So, I might sleep 12 people and it's $1,000 a night, which is great to me. But if a hotel room is $500 a night that same week, well, times those 5 couples, that's $3,500. So I'm actually giving them a $2,500 discount per night. Right. So these are the basics. Now, back to the thing you said though about the occupancy. What is the rent in these long-term rentals? Give me an example. Give me a number.
The ones that we were doing?
Yeah.
1,200, but they were 2-bed. They were basically townhomes. So
Okay,
$1,200.
so $1,200 a night, right?
No, this was for a month. This was for a month for as a long-term rental for night.
Oh, we were getting like $90, $100 a night.
Yeah, it was not good. It was like $100 a night we were getting.
But let's take a step back though. If you had dropped it to say $75 a night, but you were now renting it for 24 nights a month, right? That's the spread. That's that active calendar management. You know what I mean?
Yep.
That's going lower and understanding the market.
Yep.
And that's a very thin example, but it also goes back to, like you said a second ago, a 2-bedroom. So it really doesn't work, right? But if you said to me, hey, Mike, I want a lake property that I can enjoy, and Nebraska got lakes, and you guys are all fucking flat on.
Yeah, man. I was swimming in my lake this morning. Come on, man.
Yeah. So if you got a lake house that's a 5-bedroom that you want to use a few weeks out of the year, okay, well now we can start to underwrite that, and we can look at the data. And now you get a multi-million-dollar vacation home that you can enjoy, that's on great dirt, that has a different market, a different asset class for you, that is being run in the hospitality vein, because that's what it is. And where you guys would excel, in my opinion, as short-term rental operators, is you guys are good operators. So good operators solve problems. And the STRs have a lot of inefficiencies as well. And you get awarded for being a good operator because the customer has a lot more power in a short-term rental than a long-term rental. So that's just my food for thought.
No, that makes sense. I think I'm going to start short-term rentaling my house right now. I think my wife will love that.
I'm sure the HOA would love that.
No, thank you. That makes sense.
But I don't know if I heard an answer yet to Colin's question. The reason I'm pushing this is because it's what's kind of held me back as well, is regulation. So one of the things that worries me.
Only invest in a market that has established regulations.
Okay, so this is something that I believe that you and I were talking about. There's regulated, there's just regulated and unregulated, but define those, because I had never thought about this before until I believe it was you and I discussed it.
So when you look at a buy box, when you go to a market, right, and it's becoming more prominent now, only invest in a market that has established short-term rental regulations. So there's a market, for example, up my way, Manchester, Vermont, right? So like one of the ways we find markets for short-term rentals, you ever heard of the Keepin hotel brand? I don't know if you guys know them or not. So they do a great job of identifying great markets, whatever. It's like Starbucks, right? You see a Starbucks, you can buy a multifamily building there. So we look at Keepin probably twice a year because they don't really just pop up hotels that often, but they're a good lead on where people are going. They're hip, plugged in with that. Manchester, Vermont is a phenomenal market that there are short-term rentals existing, Chris. They're already there. They're doing quite well. I personally will not buy there because they haven't established regulations yet. So I don't want to run the risk of I buy something and they change it overnight on me.
No, I know. And I'm somewhat playing devil's advocate, but I'm also speaking out loud because this has been in my head before. Let me give you an example. We've been looking at Naples for a long time, and I love Naples. Yep. But I have heard that they had regulations that the minimum was a week, but the regulations recently got changed so the minimum was a month. And that would just scare the shit out of me if I bought a $2 million house that I thought I could rent by the week, and now I got to find somebody who can stay there a month. And by the way, a place like Naples, you're only renting out from November to May anyway because of how hot it is, and now I got to find 5 people to rent for 5. I'm not saying you're wrong. I'm saying those are the things that have worried me, is that of course, if there's no regulations, you could be surprised by new regulations, but you could also be surprised by current regulations changing, I guess is my worry.
Okay. So, a few things unpack there. One, you can rent year round if you're active and you buy the right house. I own in Arizona. It's 117 degrees right now. Plastic's melting and there's people at my house.
Phoenix?
Fountain Hills, just outside of Scottsdale.
Oh, yeah, that's nice.
Ironically, just outside of Scottsdale, because Scottsdale is basically almost impossible to run an STR. So staying with that, though, back to your example. If you Google this, right, because every town's different, so I don't want to miss one, but every case that I'm aware of, whenever something like what you're just describing happens, it does take a couple years to play out, but the Supreme Court of that state usually, again, there might be an example, I don't know, but everyone I do know of, ends up abolishing the regulations because they're found to be unconstitutional. Right? It's very hard to tell somebody else to do when it does get to that legal level. A lot of it is mandate and scare tactics and things like that. Mm-hmm. But ultimately, what most cities end up on is some sort of noise ordinance, some sort of registry, so they know what you're doing, and some side of fee, right? Because they want some revenue. Now, the important disclaimer is that's the city. HOAs are a whole different ballgame, and I see people make this mistake all the time. An HOA can ban short-term rentals, and I always caution people. I own one in an HOA, and it's fine because the entire island's built on rentals, so I was confident with that one. I won't buy another property in HOA unless it's a similar circumstance to South Carolina where it's designed for it, because you get a couple pissed off neighbors that have a lot more time than you do, and it could ruin your world.
Right.
But the city stuff, if you can survive, like Naples is a perfect example. I would let's say you like Naples. I get a pulse on that market. I'd see where it's at with the legislation. See, because remember, Airbnb, all these companies have these advocates fighting these laws. And it might be a good time to buy, potentially to hedge against when that swings back. Because when the court does rule, 99% of the time, especially in a state like Florida, they're going to rule that's a gross government overreach.
Right.
And that's really what it is, right? I can't tell you what to do inside the walls of your four home. I mean, you pay property taxes.
No, for sure.
You know, an HOA is an optional thing that you opt into. The government, very different with your home ownership, in my opinion.
No, I think it's a great way to explain it. You know, the registration or licensing thing is a worry too. As long as they didn't implement it as a surprise. Like, let me give you an example. We've been looking in Colorado forever, just because we love Colorado. We have siblings there. But there's a 7-year wait to get a license to rent in Breckenridge, where in Vail, you can do it right now.
Yeah.
So that's a little hotel lobbying there. But, you know, I would worry about buying a place in Vail, renting it out, and then having the crew come in and say, you guys keep renting out, but you need to jump on and get a registration. And then you find out now you have to wait 2 years if there's no grandfather. But I'm playing a lot of devil's advocate. Yeah. Everything you're saying is 100%. That's the type of due diligence needed to make an educated decision.
Yeah. And even then, like, play that out for me, right? Like that's and I hear you on the devil's advocate thing, because obviously, you know, I can tell you pull triggers with your company, but I mean, I can sit here and tell you a million things that are going to go wrong, but just play that out logically, right? Let's play out that argument logically. They're going to show up. They're going to say, okay, now this is registration, and oh, by the way, you have to wait 2 to 3 years. 0% chance. I mean, just in the court of law, you'd have a lawsuit on them all day, right? And that's what I think. This is just a whole different issue. But it was like the COVID mandate. The COVID mandate was amazing for us because we took the time to actually read it. It was the first time in this country's history where residents had to sign something under power of perjury saying if they weren't trying to get work, they would face legal consequences for their rent. We were getting evictions. We were getting paid. Everything was great, but we took the time to be thorough. Think through logically. If someone shows up and says, yeah, Chris, suddenly you need this license, and oh, by the way, it's a 3-year wait. Well, you're just going to keep renting, and then you'll have your day in court. You'll make media attention, and you're going to win.
Yeah, that's a positive way to look at it, no doubt.
Yeah, I mean, I guess, you know, Michael, also to your point, and Chris's sentiments are the same as mine. However, hearing you speak about this has reminded me of individuals speaking to us about investing in real estate, the risk, rental rate restrictions, and all those types of items. And yeah, there is a risk. There's always going to be a risk. But I think the biggest risk is, I mean, this is just more fundamental, is inaction. Now we're making action, but yeah, so I echo your points.
Well, to Colin's point, you know, we're in a lot of multifamily, and we're in a location right now that never had city regulations. And then all of a sudden, boom, you have a city inspector at your door. Say, hey, we just passed a new law. There's now regulations, and this screw's a little loose. I don't like this. I don't like the concrete here. And we had nothing to do. Like, we had to make a lot of costly fixes. So it could happen in multifamily too.
Yeah, exactly.
It can happen anywhere. But I'll tell you guys a quick story about the other side of that. And this is what I think we need to do more of a job as investors and everyone else, is pushing back. So one of the markets we invested in New Hampshire, we got pissed. We got pissed about the homeless people shitting and pissing outside. We got pissed about it being a mess in front of our assets. So we got organized. We actually formed a PAC. It's called Conservatives with Common Sense. I'm sorry if I offended any of your liberal listeners. And we went and we got the mayor elected. And the first thing he did was kept our promises. We took on the ACLU in Manchester, New Hampshire. We won. We relocated all the homeless people. We started making changes. We cleaned up the downtown, right? So it's hard when you're running your business. I'm not saying it's not hard. That's not the point I'm making. But I also think we get to a point where we don't push back on any of this. And some of this is unreasonable, especially in multifamily. They want to have a unit inspection. That's great. But you're going to be realistic and you're going to play ball. And every time people stand up, you usually win. It's just a lot of people just go with it to go with it, right?
Yeah.
So I get that legislation can change. I get things can come in, but also, are you going to town meetings? Are you speaking to your electmen or whatever, mayors, whoever you're using? Are you getting involved in that fight, or are you just rolling with the punches? Because you can't have it both ways.
No, that's just ready to go fight.
So when you're buying these really large SDRs, are you often using creative financing? Because 5, 4, 5, yeah, because those are very expensive themselves.
I'll tell you about the one we just did, Arizona.
Yeah, can you break down? Do you mind breaking down all the numbers and everything?
I'll run through the whole deal.
Awesome.
So we went out there this winter to see if we wanted to like living out there. We loved it. Identified Fountain Hills. Back to same fundamentals we talk about, right, guys? You got to be able to have a DSCR. You got to be able to cash out refi, yada yada yada. So we found a deal. There was a distressed seller. They're going through a divorce. It was a 1.6517 house, which those houses tend to sit a little longer because, there's not a lot of people buying a $1.65, $1.7 million house when rates are up. So we kept peppering them. They finally had to sell. They thought they were going to, quote, save money by using a family friend as the agent, which is great because whenever I think people get frustrated, right, when you see a bad agent on a deal, and I actually get excited because what I say is if they're being this difficult to me, they're being this difficult to everybody, and most people aren't as stubborn as I am, right? So it's an opportunity. It's all how you look at it. So we ended up getting it for $1.2 million, and then they gave us a $65,000 cash credit at closing to replace the HVAC. So then I go to one of my hard money lenders who I've done a lot of business with. And I said, look, I don't want to buy this property. I don't want to put anything down. We'll do our regular deal. They put a second mortgage on one of my other assets. I put down like 5%. I pay a few points. I get a 6-month note. Now I got a refi. I then go to a DSCR lender, so they don't care about the comps. I get my DSCR and my analysis from PriceLabs. A DSCR ratio on a DSCR loan is only a 1-to-1 ratio. You don't even need the 1.4 or the 1.25. And I do a cash out refinance, right? They look at repairs you made. So we did put a couple of bucks in. They add that with the purchase price if you do it under 6 months. And we just did a cash out refi on that. We have an infinite return in about 3 months on a 1 point, I think it appraised at like 1.7.
That's nuts. What's PriceLabs?
PriceLabs is a tool that we love that does a few things. One, it sets up your pricing for your short-term rentals, and it will automate your pricing and adjust your calendars. But the feature that's on there, I don't think it's talked about enough, is called their market dashboard. And I think it's about $10 a month. You can search any market, any address you want and compare apples to apples. Because that's really the big thing in short-term rentals, guys. You've got to compare apples to apples. Everyone always says apples to oranges, right? And the data will skew dramatically. So, for example, in Montana, I don't know if I still am. At the time, though, I was the only one in Bozeman that was a 6-bedroom with a hot tub that was pet friendly. So out of the whole market where there's hundreds of short-term rentals, I'm the only guy in that box, right? So we look for those inefficiencies again, and we start to build the business plan and then work backwards.
Interesting. So we had, what was the gentleman's name that does a lot of Airbnbs? Jorge?
Here in town?
No, he was in San Diego. But he mentioned some of the same things that you just mentioned about comparing apples to oranges. The hot tub is when I filter on either houses that I am looking at for short-term rentals or just a short-term rental to stay at, those are definitely the filters I'm putting in. I'm putting in pool, I'm putting in hot tub, I'm putting in game room or basketball court or something like that. And all of a sudden your large list goes down to this big. And typically those are the ones that are more desirable, which means you basically create your own market is, I'm guessing, what you're getting at, right?
My one in South Carolina, craziest deal I've probably ever done. It's literally on the ocean. So during high tide, the waves literally come up to my property. I mean, you can see it on Zillow Gone Wild on Instagram. It's insane how well it's done. And literally it has, I was looking yesterday, I think I now have like 120 reviews in that property. And it's 4.99. I am booked at that property 332 days out of 365 days in a year.
That's nuts.
And we bought that for 325. There was a whole story there. Praised for about $1 million, and it does about 200,000 in revenue a year.
Wow, that's a decent deal. How are you? You said the previous deal, Arizona distressed, et cetera. This is always a popular question. Sometimes I get frustrated when I get asked it. How are you finding your deals? But I'm going to ask you because you're finding a unique assortment. We are typically sticking into our market, so like it's almost all networking, and maybe that is for you, but that's kind of a lot of markets that aren't, adjoining. How are you finding them? What are some of your techniques? Are you just going out on Zillow, banging on doors, sending letters?
A few different things. There's three buckets. There's brokers, there's networks, and there's self, things like that. So the networking is a lot of direct to seller, a lot of leveraging other people we know. Broker relationships are there, and then again, I keep hearing the same themes, like solving problems, right? So the one in South Carolina, I looked at my mother-in-law, of all people. We were at their house. I said, I want a house where I can walk out on the beach. So then I go on, again, we're spoiled with technology. I just start setting up all these filters and all these things in Zillow, and I start looking at markets. Then I might see something that looks good, and I work backwards, right? I might say, show me things that have been on for 150 plus days, that have this many bedrooms, that have, say, a garage or a basement. Like the Montana one was a perfect example. Again, I don't know what it is with people in divorces. The guy's going through a divorce, so he had to sell. This is damn divorce attorneys.
Yeah, assholes.
The guy had to sell. He was a builder, so he used, again, a family friend, similar pattern, shitty photos. I didn't want to go see the house that looked so bad. I pull up. I have an unobstructed 360 mountain view range with a 20-foot high wall of windows that they never put a single listing photo of. So then I get there, and the basement, the house was 2,500 square feet finished with 3.5 bathrooms. You go down to the basement, it's already all studded out because he was going to finish it. He never did it. So that one, we bought it for $970. We finished the basement for $140. We added 3 bedrooms and another bathroom. We refinanced 6 months later. It appraised for $165. We pulled all that cash back out, and now we have it.
That's awesome.
So it's just finding those things.
Yeah. So when you're setting these things up, and I'm focusing on the short-term rentals, but I know it's basically the same thing as multifamily. It's just at a faster cadence. So who are the key people that you're putting into these markets or contacts that you need to efficiently run these? Like, who's your core group?
You need a great cleaning staff, and then you need, I would say, 99% of the time, if you find the right cleaning staff, they have all of the network you need. They have the maintenance guys, the plumbers, because really all you really need in STRs are really plumbers, handyman, and cleaning staff. Those are usually your 3 big things that kind of drive everything. And also, usually the agents that you're using, because a lot of these are residential deals, have networks and people. So if you leverage those 2 things, you'll find everybody you need. And then you got to spot check and set up the technology. That goes, again, back to the tech, right? Like, we use Hospitable, and that automates all the messaging. It automates all the check-ins, the checkouts. We have keyless entry smart locks. I mean, there's so many things that it really is set it and forget it if you buy it right.
Yeah.
And that's why it's real estate investing. It's fundamental. That's why, like, I cringe. Like, there's so many people in the STR space that've got, like, these podcasts and blah, blah, blah. I don't think they understand the fundamentals of NOI and cap rates.
Buy low.
And to me, I just saw it. It's the same industry. So when I heard all that talk, like I said earlier, about, well, you can't rent to people because if you lower your price too much, the damage they might do. Like, what are you talking? Like, that's moronic. I don't understand. So I don't know. And that's why I think a lot of those guys are all doing, quote, boutique hotels now. It's like, it's a fucking guru thing. Like, that's all it is.
No, I mean, a deal is a deal. Like, if you find real estate in a good area that's at a good price, that you see there's a value add component that's under what it's worth, or you can add that value, that's a good piece of real estate for the most part. If you're having people, like, if you ever have and now this is in the weeds, but I'm going to go set all my Zillow filters for any place that I want a short-term rental.
I thought about that already.
Do you just have the cleaners or the maintenance person say if something breaks, they go over there and they help them with the technology or something like that at the pool? You just keep one of those people on retainer?
We set everything up through the cleaning staff. There's apps that do it too. We still use WhatsApp. There's plenty of apps to do it. We do pre-turn photos, post-turn photos. We have checklists. It gets uploaded. It gets documented. Like little stupid things, right? Like people don't think of. We make our staff take a photo of the pool every time. The pool rules. Well, why? Well, if someone gets hurt, I want more protection to show that these rules were posted before your stay and you violated these rules.
Yep.
Right? You can tell your landlord, because until you get sued, you don't start thinking about all these things. So it's little things like that. And then that staff will handle it, Collin. But the biggest thing there is, like, let's say you set up those Zillow filters. You guys do it. Find an area. That's what I want to push back on. Because again, right, it's another, how can I say it? It's a widely held belief that I don't necessarily agree with. Chris was talking about Naples earlier. Naples obviously has a peak season, has a book season, and has a shoulder season. But you can also rent in the slow season if you're that guy. My house in South Carolina, my cleaning staff happens to do 3 other ones, and they go, man, you guys don't stop. Everyone else stops. And that's when it hit me. Like, I'm like, shit, I should be buying more on this island, because that means there's no sophistication. Because I have a ton of demand, just no one else is using PriceLabs. No one else is using adjustable data. So like my house in Arizona right now, my peak pricing guidance in the winter, in my January through, say, March pricing was $1,400 a night, right? That's my peak. I'm getting right now $300 to $400 a night, and I'm happy.
And does PriceLabs just automatically set that for you?
You have to set that within PriceLabs with what they call seasons. It will try to set it, but if you just set it and forget it, there's too wide of a gap. So we break it up into 4 to 6 seasons.
Yeah.
So it doesn't skew it too much. But we do another thing that, I had a couple people that I know in the industry, they used to fight me on this, and I think they finally come around to what I call active calendar management. We manually check our prices 60 days out and 30 days out, and we'll adjust our prices. We'll change our photos. We're experimenting right now with putting up all the listing photos of like twilight, like dusk photos. I think that looks well. Little things like that, because again, you have an advantage as an operator to tweak it. And that's where it shows. And at the end of the day, we have, multi-million-dollar homes now in 4 different states that are gonna, kind of insulate a little bit against multifamily, in my opinion, right?
Yeah.
So now I've got a little different asset class, and that's a whole different buyer when you go to sell it. Like we own in a market up in Maine called Kennebunkport. We own 3 up there. That's a multi-deal market. The first deal we ever did, we bought that one for $300. Today, that house is probably worth $2 million.
Wow.
That's a single family house.
Wow.
You said you use a DSCR lender. Do you mind naming who that is, or is it a national group?
There's a ton of them. I happen to use Visio Lending, but there's a gazillion of them. And DSCRs, this goes back to the piece that I think sometimes, the creativity, that's what I like about real estate, rewards it. It is not hard to make something pencil at a 1.0 DSCR. And you have to be careful to not overdo it.
Yeah, actually be a 0.8. Yeah.
Yes. Yeah. I want an infinite return. So I'm always looking for that value add piece. But yeah, you could use Visio. You can use anything. And, like I'm looking at one right now in a Cape Cod market that's very unique that, the people want $2.2 million. I offered $1 million. I slashed their price in half because they know and I know that house is going to fall into the ocean. But what they don't know that I know is I have insurance lined up already. So if I pull that off again, I just got to get a DSCR lender. I'll rock it for as many years as I can. And then whenever it goes in the ocean, it goes in the ocean. But that house is a perfect example where at $1 million, that house is going to do probably $400,000 in revenue a year.
Wow.
So if I can get 3 years out of that, I'm all set.
So you're not taking these phone calls and stuff when someone can't figure out the locks or anything, right? You said that's automated through Hospitable.
That's automated through Hospitable, and we have a member on our team that does that. Mm-hmm. But yeah, I would say 95% of communication is automated with short-term rentals.
That's awesome. We've got like 10 more minutes, so I want to make sure that we get a little bit into the multifamily. So how many units are you guys at now?
Oh, I hate that question.
I know. But I'm going to ask you because the relativity towards it is it's going to lead into my next question. It's not to say how cool you are.
Just you and I both know like door count is so.
Yeah, but it leads into the next question.
All right. I'm like the worst. Chris is like, man, this guy just cursed and calls everyone stupid all the time. That's going to be the worst part.
No, that's right.
No, trust me. I do not like saying unit count either because it's not relative, because the relative is what you purchased it at to what it's worth now. Really, that's the only thing you should care about.
Right. It's your equity. How much equity?
That's all you should care about. Yeah. But I'm not asking your net worth on here.
Yeah, we're at like just multifamily. I don't know, a little over 500. I can tell you exactly.
Okay.
We've got another 38 under to close. And so that might put us close to 600, something like that.
Okay, so the reason why I was asking that is there's always like these pivots, and you're just hanging out with you a few times. You're a big process guy, but what's some of the biggest challenges you've had as you've grown, and what's some sort of pivot, or what's something that you've implemented during that time? And so that's why I asked the unit count, because if you had one house and had $20 million of equity, obviously that would be like a massive home run. But there is something different when you start to scale and how you do your processes, and you had referred to that earlier.
100%. And I think the biggest thing is, and I tell people, I think I'm a really good real estate investor. I think I'm learning to try to become a decent business owner. And I think the thing that no one tells you when you start real estate investing is that they are two different things. And we're learning that now. And having employees is great, but understanding that this person, despite how frustrated you get, is not going to care as much as you do. Yet as you scale, they're responsible for more. And that has been a steep learning curve. That is, we've had to put processes in place. So as you know, we started to implement EOS, scorecards, getting employees to move with urgency. I think is everything. That's been our superpower to this point, is that we move fast, very, very fast. And I'm trying to find a way to get the team, as we continue to build, to turn that wheel. And I've also learned recently that, and I will bet if I put it back on you guys, it'd be the same for your business. I don't know if you thought of it this way, because I didn't until recently, actually working with a good friend we know, Ian Bishop. I actually have another business within my business. So right now I have my asset management, my property management, but here's the other business I have. 90% of my big wins come when I get a building to stabilized. So we're putting the equal amount of attention on our stabilized and unstabilized, when in reality, I should get like all my Navy SEALs, my best people, and maybe even higher, just to get my buildings to stabilized even quicker. Right? Because if I say I take a 2 to 3% NOI haircut on my stabilized stuff, that hurts a little bit, but it can be addressed. But where right now I'm stabilizing a couple hundred units, for example, if I get to my cash out refi, say 3 months quicker, well, even if I pay another $100,000 in payroll, but now I've got all that investor capital back to redeploy. I've got my cash out refi. I'm out of my hard money. I'm cash flowing. All the big pots of gold are at the end of the stabilized process. So how do I turn that flywheel even faster? And that's the process we're really redefining right now. Yeah.
So what are some things that you're doing there? Because I couldn't agree more. Your biggest friend and biggest enemy in real estate is time. I mean, you have to be fast. You have to be effective. You have to be a killer. Every day you have a down unit. Every day you have somebody working on a vacancy. Any of those things that you have hard money loans out, those can cripple you, absolutely cripple you. I mean, I've had a couple of projects, just some flip houses that took way too long, and it is absolutely, it destroys your entire NOI. I mean, it just destroys it all from those lack of efficiencies. So how are you going about this process?
I'll give you a real world example. So we do a lot of Section 8 C-class housing. So we learned we're really good at dealing with housing authorities. Maybe that's our education background. So we had to do some creative stuff. So Cleveland, for example, is notoriously known for dealing slow. So we said, okay, what do we have to do to accelerate that process? Because we can't wait 3 to 4 months to get someone in a unit. Well, we went out, we flew out, we met with them. They weren't being receptive. So we got on the phone. We got all the way up to the media director, which got us a meeting with the CEO. We then hired a consultant on our own dime from back here in New Hampshire to work for us independently to fill out the housing paperwork and meet with them, because she knows the federal law so she can speak their language. We then partner with other organizations within the housing authority that actually can skip the entire Section 8 process, and they can move people in 7 days or less. So we became their best friends. So it's little things like that that help fix some of the inefficiencies. On the management side, big on the scorecards. What do I want to know? I want to know collections. I want to know vacancies. I want to know loss to lease. I want to know unit downtime. So we really broke it down to the things we want to know. And then we started working backwards. Like we have a 90-day look ahead process. We go out, we inspect the unit 90 days prior to the lease ending. We start to look at how many times they paid on time, how many times they've paid late, how many maintenance tickets. We then get a scope of work of what it would cost to turn that unit in the event of a move out. We compare that to the market rent, any loss to lease. We make a decision to keep that tenant or replace that tenant. And that triggers a chain of events of actions. In the event we're going to keep them, we start engaging them for a renewal. If they say yes, my internal team gets a bonus based on that. If they say no, and then we flip them back to a yes, they get a bigger bonus. If it really is a no, we start the work day one that tenant moves out, and that unit's being marketed via a ghost ad prior to the move out. So hopefully we have someone leased up. And our goal is to try to keep all of our units vacant for 7 days or less. Doesn't always happen, but that's our goal.
That's awesome. What I really like that you said that I did it when I was when we were smaller, and I have it on the list now to add it to some of our KPI scorecards, is the resident tracker of the times that they were late on rent, maintenance requests, and other items. That's a key piece that it's somewhat internal conversation, but we don't have it documented. So I really like that. That's a great KPI. I think a lot of people don't think of it. It's the typical process. We have a 90-day process as well. Same thing. You're sending notices, following up. Then you're obviously posting it as well. But that's a really good tangible item that's often overlooked. So yeah, brilliant.
You're motivating me, man. I'm excited for the next time I have a little bit of time to sit down and enter all those prompts into Zillow. Because every time we go to a place, we come home, and now our family's just laughing at us because we're always like, oh my gosh, we're going to get a place. We're going to get a short-term rental. And I never pull the trigger, mainly because I'm being a little wuss about those things. But it's so great to hear you see somebody who's doing not only what we do in the multifamily space, but applying a lot of those due diligence and being a solid operator into the STR space, because what a great reward for you to be able to go to one of the places you own right on the ocean just because you know how to operate.
Yeah.
Well, I appreciate it. And another tip to that too, because I know you guys are like us, you're raising money. It's the creativity it allows, right? So there's a shout out to these guys, and I'll just share it. And there might be other ones, but I'll talk about these guys because this is another untapped market with those luxury homes. There's a website now called Better. They do HELOCs on investment properties and second homes. So now you have these multi-million-dollar homes, all this equity you can tap into and also leverage that capital as well. So I just love the hedge and right, the way my brain works. Okay, so say you're getting a multi-million-dollar home that might be break even on the STR side, but you really like it. Well, now if you can tap into some of that equity, well, now maybe you're doing hard money loans with that equity off that HELOC, you're getting a spread. Yep. Now you're still getting that pay down, you're keeping that that luxury home that you're getting to enjoy, but you're also still covering, it's still paying for itself, right? So again, man, it's just problem solving. That's really kind of the big takeaway I tell everybody is how good of a problem solver are you? And if you're a good problem solver, you'll make a lot of money in this space.
Bigger the problem, bigger the payday. That's what Alex Hormozi says, and Michael Ketchen. Last question. I was going to ask, what are you most excited for? But what do you like most about what you do?
I'm a sicko, but probably this. I'm a former teacher, so I love seeing somebody grow and become the best version of themselves. I love seeing someone get in the arena. I love the lifestyle it affords. Me and my wife make it a point. We don't have kids, so that definitely helps. But we travel like every other month, right? We live in homes. We enjoy homes. We do experiences that, I saw my dad die at 46. I'm about to be 40. I don't want to wait. Like we just, it's so cliche, but people think they appreciate time. I really don't think they do.
No.
I don't think people realize, and we're crippled by opportunity, dude. Like when our grandparents were coming up, what were their options? Go get a job. That was pretty much it. We are all walking around with a goddamn supercomputer in our pocket. We can do anything, but design what you want, work backwards. And that's the teacher in me. That's also what we've done. I told the story the other day, my first why when I quit, I just didn't want to send an alarm clock. Like, can anybody say they're truly free if someone else controls your time? Right. Well, that was my first why. Now it's, okay, I want to retire my mother. I want to retire my friends. I want to enjoy all this together. So I get excited because I'm going, when I do this cash out refi and this Cleveland deal, this newest one in New Hampshire, I'm writing checks to people that have known me since I was 5. They're on the ride now. They're in the fucking arena.
Right.
So now they're betting on me to get us all there. So that's what I love.
Dude, that's amazing. Michael, it's been a pleasure. How can people get a hold of you?
Yeah, please check out the Instagram, Michael Ketchen. launching a podcast. Hopefully I can get you guys up here for an episode. We do it in person. We don't do Zooms.
Cool.
So I gotta get Collin. Chris seems like he's very humble. I know Collin's a big deal. I don't know if Collin will get on a plane.
I would suggest you don't do any Zooms because you'll probably fuck it up. I'm kidding.
That was such a good one. Oh, you nailed that. Yeah. My wife's been wanting to go to New Hampshire forever. So yeah.
Thanks for calling me humble, Michael. I appreciate that. That'll be a surprise to my wife.
Dude, you've been called humble. He's been called humble and authentic today. You know, jeez, man.
Yeah.
Nice to meet you, man. Collin had a lot of great things to say about you. I'm glad you guys met. You've been super interesting, but honestly motivating. Like you said, we do a lot of the same things, but it's always just freaking motivating to hear somebody else doing a little bit differently and being super successful. So thanks for coming on.
I appreciate it. Thank you guys for having me. And Collin, I'll see you soon.